The Everything Apartments podcast is provided with support from the Apartment Association of Greater Los Angeles, better known as AGLA, serving residential landlords throughout Southern California through education and advocacy. Visit aagla.org. Hello, everybody. Eric Christopher here, and you're listening to the Everything Apartments podcast, where we dig into all aspects of multifamily investments from buying and financing properties, day-to-day operations and management, and also reinvestment strategies. The 1031 exchange is a very efficient and popular way to defer capital gains taxes in commercial and investment real estate. And the 1031 refers to IRS Section 1031, which allows investors to defer capital gains tax on the sale of business or investment real estate if the proceeds are reinvested in similar like-kind property. And it is tax deferred, not tax free. The exchange requires certain timelines. For example, 45 days to identify up to three properties of which you'll buy one or more of. And then the more hard deadline is 180 days from the time you close the property that you're parting ways with to closing what you call the upleg. And also using a qualified intermediary. We'll get into that. We'll drill into the mechanics of the 1031 exchange, which are really pretty simple, but we'll focus more of this episode on what you can invest in once you've put the process into motion. But first, I'll tell you about our firm, WSC Realty Advisors and WSC Property Management. WSC has been helping buyers and sellers and managing apartment properties in Long Beach for over 18 years now. Let's say you're tired of managing your units, you want to travel more, kind of relax on vacation without worrying about a plumbing leak or some other issue when you're far away from home. Or maybe you have a manager and you're just not quite getting the response or the results you're looking for. It could be a lengthy vacancy or lingering repair issues that seem to go unnoticed or, flimsy reporting. We can definitely help you. WSC isn't here to be the biggest management firm in Long Beach. Instead, we stay a little smaller and more agile to bring you the quality of service you really want. For example, we get our owner reports to you by the 10th of each following month, or your next month of management is free, but we've never failed on that. We can also help if you're looking to acquire more units here or out of state, or looking to do a 1031 exchange, exactly what we're talking about here today. And that could be either locally or out of state. Visit WSC-PM.com. Call, text, or email me. That information is all in the show notes. Or obviously, if it's you're watching on YouTube, it's right here next to me. Whatever the challenge is with your property, WSC has the solution. I created this episode and I dedicate it to two brothers who are some really great friends of mine. In fact, I consider them more like family, and we actually call each other cousins kind of in a joking fashion, but we are very close. My friends are in the early stages of the sale process of a commercial asset that's been in their family for decades and will very likely move into their first 1031 exchange. Now, I know a lot of us out there have worked around 1031 exchanges for years or decades. In my 20-year practice, most of the sales I've transacted have been a part of a 1031 exchange. But I kind of structured this episode in a more kind of 101 class or a beginning level for somebody that's never done it before and has a lot of questions, and it's a little bit of a kind of a foggy bank that they're going to be walking into. So this is a brand new experience. I'm hoping to provide a little better clarity for them and anyone else in the same position or sometime in the future. So as I mentioned, the family owns an industrial warehouse that's housed the family business in Orange County for many decades, and the family is really ready to divest. Now, we estimate the asset at the value of approximately $3 million, dollars, and we'll kind of use their scenario as our example today. The father in the equation purchased the property in the 90s for around $350,000. For a 1031 exchange, you're basically transferring the property's basis to another property. Now, let's talk a little bit about basis. And it's not terribly involved to understand, and certainly your CPA or tax preparer can arrive at what your basis is very simply. But the basic equation is purchase price of the asset plus capital improvements. That's the big stuff that you actually capitalize on your taxes, less accumulated depreciation. So for discussion purposes, with depreciation having been taken for 30 plus years on this asset, let's say their basis is going to be pretty close to zero. This means if the property sold for $3 million, the entire amount and all the depreciation taken would be subject to capital gains taxes. And obviously, that's a huge tax bill. The exact amount of tax is based on someone's tax bracket, but let's just say that the bill on this one could easily be $900,000 or more. So executing a 1031 exchange will defer that tax bill and transfer the owner's basis, in this case, at or close to zero, to a new property. And this is precisely why people love to do 1031 exchanges. Now, when we list the property that they're going to move away from, in this case, the industrial building, we call that the down leg side of the exchange. And the process is really no different from any other sale. We market the property, locate the best buyer possible to open escrow with, and move toward the close. So the sale process pretty much proceeds as normal up to the end where we'll take a left turn into the 1031 process. Now let's touch on the mechanics of the exchange and how it works, and it's not terribly complicated. As we're following the scenario, the sale of the down leg is about to complete. Now, the first thing you'll notice with the 1031 exchange is the funds that would normally be delivered to you at the close of sale are going to divert into a 1031 exchange accommodator's account. And the way to think about that is it just basically sequesters the funds in reserve for completing the 1031 exchange. The exchanger cannot take constructive receipt of those funds. Otherwise, the exchange would be invalidated, hence the need for the accommodator. And a number of escrow companies also offer services as 1031 exchange accommodator. So the one I use, basically, it's all within one office. Essentially, you hire them to be your accommodator for a few dollars, and the funds basically sit there. Now, there's a term called boot, and all that boot is a portion of the funds from your 1031 exchange that you're going to go ahead and take receipt on. And let's say you have a need to replace a roof on your single family home or some other need for capital. It's perfectly fine to go ahead and take some of the funds out of the exchange. Yes, you're going to go ahead and pay capital gains on those funds, which is accepted and understood, but you need the capital for something and want to take it out. This still allows you to use the remaining funds to accomplish your 1031 exchange. Now, once the sale of that down leg is completed, as we mentioned earlier, you have 180 days to take ownership of a new property, which should be to perfect the exchange at or more than the sale price of the one that you relinquished. Looking at prospective properties, you'll end up doing an identification sheet for the accommodator, and all that is a little piece of paper that says we identify this property or up to 3 properties, and you'll then need to close on one or more of those to complete the exchange. Now, we've got to keep in mind with the 180-day period, if there's a new loan that's going to be employed in this process, that can take 45, sometimes 60 days. So we need to work back from that 180. We've always got to keep in mind if we're getting a loan, that's going to take some time. So you want to budget the right amount of time and really get proactive on identifying properties that you'd like to own. So for commercial properties, it's a little different dynamic on the tenancy. As we talked about with apartments, everybody needs somewhere to live, and that's really not affected by different economic landscapes. For the commercial properties, let's say retail and office, you are subject to economic and business trends. Now, this also is affected by how big the property is. If you've got some very large spaces, those can be a little more volatile in down times economically. Whereas if you've got much more of a mom and pop, let's see retail or office spaces that are at or below 1,000 feet even, those can be more resilient in that the spaces are small and many mom and pop operations need to house their business somewhere. And in this application for a $2 million investment, something like a small retail strip center or a small office complex could be just the ticket. That the exchanger will move into is termed the up leg. So obviously the one that we are getting away from is the down leg, and the new one will be termed the up leg. This is just a little bit of jargon. If you hear that, it's very simple and you know what it is. Now, some owners may already know exactly what they're looking for. And heck, some may already have a few candidate properties in mind. The good news, there's a great amount of latitude in what buyers in a 1031 exchange can land themselves into. Let's say somebody's going to sell a single family rental property, and they can exchange that into raw land or a retail strip center, or somebody selling a retail strip center could exchange that into an office complex. There isn't a whole lot of rigidity in, oh, I have to buy the same kind of property as I did before. No, you can really sort of expand your horizons into different product types if you wish to do so. It can be really any geographic location that you want. It doesn't have to be in California. If you're there, you can do other states. It really is just an entry on your federal tax return. And after that, as far as the product type goes, it's very much flexible. Now, let's talk a little bit about the existing debt that someone might have on their down leg property. If the down leg property has existing debt at the close of sale, to prevent the exchange, the exchanger must take on debt equal to or more with the up leg. If this isn't accomplished, there will be capital gains tax billed on the debt amount as it was technically debt relief. In this example we're using, it's very much more straightforward because my friends have no debt on the property at all. So that removes that component from the equation. Now, what we'll be getting into here soon with the discussion with my friends and the sellers that are going into the exchange is the propensity to put leverage into the transaction. In this case, let's say the two brothers have $1 million each to enter the 1031 exchange, and we'll just focus on one for the ease of the discussion. Now, will they choose to invest only the $1 million equity and take on no debt? Obviously, they have no debt that they're getting rid of with the old property, so they don't have to accumulate any more debt. They could literally go spend $1 million, buy the property they want, and that's it. Or are they willing to lever up the capital to, say, a 50% debt level? This would allow the buying power to increase to $2 million. So 50% leverage is relatively conservative, and most performing income properties should qualify for a loan at that level. So for example, let's assume my friends, each of them would say having a 50% LTV on the capital sounds palatable to them. They can now go out into the market and begin to place a $2 million investment in one or more property. And it's going to really pay to get into the discussions of what the replacement property looks like earlier on. And I'm talking, we're starting this discussion now, which is kind of a premise for this video, and have a very strong idea of what they'll be chasing after, because what we'll see is once the wheels of the marketing get going on the down leg, the calendar starts to spin by. And the last thing you want to do is be in a rush with a 1031 exchange with a $900,000 tax bill hanging in the balance. And I've seen it happen before where people go into properties they probably wouldn't have otherwise. And that's kind of a situation you want to avoid. So what we're doing now, even as we're just barely getting the listing signed and beginning to launch the marketing, is we're starting to talk about what will you want to move into? And that's the question everybody has. So within that 180 days, we got to be covered on something. So we'll get into the discussion. Sounds like a lot of time, but like I said, it does move fast. And it's best to start firing offers on the properties you're going to replace with before the down leg even closes. For example, let's say you have a buyer that's gone into escrow. Once we get to a point where we're pretty darn sure that that escrow is going to close, time to write offers because you don't want to wait. Now let's get straight into product type. So this little chart here has some of the more common product types on it. And certainly there are some more exotic examples such as, say, mobile home parks or, single family homes designed for a short-term rental market, luxury home or something like that. But let's get our gears turning, doing a quick comparison on these. And we don't have to exhaust this, but what we've done is across the common product types, you see them across the top. And then on the left column, we have different property characteristics. In a nutshell, investment properties all come down to income stream and short or long-term appreciation. That's why we do this stuff, right? And then let's look at the third one down. The management intensity is something a lot of people think about. It can range from nearly nothing on one extreme to something that looks a bit like a part-time job on another. And if you're not self-managing, do you know someone in the area of where you're going to purchase that you trust, maybe a family member or something? And that's a big question because you really are doing a trust fall with the manager on some of these types of assets. And before we take a look at some of these characteristics, there's kind of two sides of any property type. A value add play, which means you're going to do something to it to increase the value or performance, or a turnkey play where you say, look, I've got this exchange. I just want a nice, respectable, decent cash flow and a little bit of a chance for some appreciation. And I don't want to have to do a bunch of work. I don't want to have to invest more money to reposition the property. Property location and grade is also another thing. But let's take a look at apartments. Apartments are kind of what we would call the doorway for investment real estate. They're pretty easy to understand. We've all probably lived in them once or twice in our life. The good part about apartments is if you get a vacancy on a Friday and it's ready to go, if you put the rent down at a certain number, it'll rent over the weekend. The offset is kind of the maintenance and repair and the management intensity of it. Wherever you have people living, there's going to be stuff that's going to wear out and break more often than, say, a retail strip center or an industrial property. And pound for pound, you do have the most plumbing. So it's available in all grades, but the income stability is pretty good. In most markets, apartment vacancy rates are lower than the other property types. In a market like Southern California, most owners can report that they run with maybe a 3% vacancy. Obviously, it depends on how high they try to push the rents, but 3%. And there's a lot of buildings that I manage that like have less than 3%. A couple of them haven't really had a vacancy in the last few years, and the owners prefer on those to keep the rents a little lower in order to avoid the vacancy. So that income stability is key. Now, appreciation potential, that's where we figure out, hey, when we buy something for $2 million, can we assume that in a few years it's going to be worth more? Obviously, the rents go up, the value goes up. But we do have different characteristics and appreciation potential. So kind of sliding back over to the apartments, we've got a pretty good handle on the income stability and the appreciation potential. But you'll see the management intensity of it. It's the highest one of the bunch. You have people living in the units. That wear and tear does more so than, for example, a retail strip center or an industrial property or self-storage facility. So you should be ready for a little more management on an apartment complex, whether it's you or somebody you hire, different characteristic there. Now, capital expenditure requirements. What does that mean? Well, that means typically roof, plumbing, electrical, the big ticket items. I'm not talking about just a hair clog and a sink. I'm talking about repiping. I'm talking about having to convert main breakers over, roofs, foundation. We do find a similarity with the first three, apartments, office, and retail, that the CapEx is probably about the same. Going back, if you look at the single tenant, there's a reason for that only having 1 star. You're not going to have to put anything into it after you lease it. We'll get to that in a minute. Tenant risk. Let me point something out that differs from apartments to kind of the commercial sector. As I said before, if you have a unit somebody moves out of on a Friday and it's in good shape and you clean it up on Friday afternoon and you can show it, you put the rent at the right number, it'll lease over the weekend. I've seen it happen. So for commercial properties, it's a little different dynamic on the tenancy. As we talked about with apartments, everybody needs somewhere to live, and that's really not affected by different economic landscapes. For the commercial properties, let's say retail and office, you are subject to economic and business trends. Now, this also is affected by how big the property is. If you've got some very large spaces, those can be a little more volatile in down times economically. Whereas if you've got much more of a mom and pop, let's see, retail or office spaces that are at or below 1,000 feet even, those can be more resilient in that the spaces are small and many mom and pop operations need to house their business somewhere. And in this application, for a $2 million investment, something like a small retail strip center or a small office complex, small in multi-tenant industrial property in Long Beach or Southern California, those things are always in high demand. So you'll experience a lower level of tenant risk, or called vacancy. Maintenance and repair level. We already kind of talked about that, where people are living. Apartments do have the most maintenance and repair. So you got to be ready for that. What I recommend with owners that have units where the tenants have been there for it could be a decade or more, I start to tell them, look, they're going to move out sometime. And when they do, that unit's going to be trashed. It's got, 15 years worth of living under its belt. Pretty much you're going to be almost down to the studs, if not, and everything's brand new. So if you take a look at your 8 unit building and you have 2 or 3 tenants that have been there, 10 or more years, maybe even more than 8 years, you better start putting a war chest together for when those people leave. So I recommend that to counter the maintenance and repair level. As you can see, the others sort of go to moderate to low, and that's the difference in apartments. Tenancy and the income stability is high, but so is the maintenance and repair level. So kind of ideal for investors seeking. Go across there. Steady cash flow and long-term growth, right? So you can kind of see there's one line description of what you might want to look at. Key benefits. So those are just some extra side notes, but all of these product types are available to you. Now let's take a minute and touch on 2 of these product types: single tenant net lease and self-storage. Episode number 2, way back when I first started doing the podcast, is covering the self-storage product. And then episode 17 goes in depth on the single tenant net lease. I'd suggest anybody, including my friends that are heading into a 1031 exchange, go back and listen to those 2 episodes. But we'll touch on them briefly here. So single tenant net lease, basically it means to purchase a piece of real estate, for example, a building that has a Kentucky Fried Chicken, a Taco Bell, an Advanced Auto Parts, different national brands that we all know. And what ends up happening is you as the investor buy the property. Usually it includes the dirt and the building on top of it. But the beauty of this, and the reason why people like it so much, is, for example, Kentucky Fried Chicken could already be there, or they're moving in if it's new construction could be a 20-year brand new lease, or you can buy them on the secondary market with lease times ranging from 5 to 10 years and up. The beauty of the net lease structure is the tenant has all responsibility for the property. They pay the taxes, they pay the insurance, they do the maintenance and repair. There's literally zero landlord responsibility other than just making sure that the rent came in either over the wire or in your mailbox. And I have a few investors that have bought these and they've never actually visited the property. There's really no reason, because there's nothing for you to do. So this is a very, very popular 1031 exchange destination. And for that matter, out of state is in play. What you're looking for with the selection process is, obviously you're putting all your faith in the tenant. Now, is it corporate backed? For example, a lot of Jack in the Boxes are corporate leases, and then they have a component of them that are franchisees. Taco Bell is a huge one, which is almost all franchisees. Now, what you got to do with the selection process is really analyze who the franchisee is. The one I just completed the sale on for the land lease, the operator or the franchisee had over 250 units. They're looking pretty strong. Then how long has it been a Taco Bell or a Jack in the Box? In this case, the one I just completed sale on had already been a Taco Bell for 25 years. So certainly that plays into it, the stability, because the downside risk to that is if the franchisee goes belly up, or they decide they don't like the location because they haven't been long enough to figure out if they like it. The last thing you really want is a dark space there. Now, in some places, it may not hurt you too bad if you're on an out parcel by a Home Depot or a Target, which is where a lot of these things are. You'll probably find another tenant comes in, but certainly it's suboptimal as to having to worry about. But the pluses are huge. The management responsibility is zero. And let's touch just a bit on self-storage. Self-storage facilities are kind of the darling of the investment real estate market for the last 10 or more years. Now, they're not terribly easy to find in smaller format. $2 million is kind of maybe the floor to that. A lot of them are much larger than that, but in different states, you can certainly find one that of different sizes and different classes and grades. And the beauty there is it's sort of like an apartment complex, but you don't have anybody living there and you don't have any plumbing. So certainly there's a business operational component that you'd be taking on with that. And that's one thing that maybe some people wouldn't want to do, is either run it themselves. And I know a retiree that's having a great time with one of them. He says, heck, this is great. I own this asset for my 1031 exchange. A lot of them are fully automated now, so that the entry process and everything else is done without any on-site staff. But this old guy would work in the office and tend to the customer needs for 4 hours a day and then let the automated process take over after that. So they really are kind of the darling of investment real estate if you can find the one of the right size for yourself. So in summary, once you go through a 1031 exchange, the sky's the limit on the product type that you move into. There's pluses and minuses in every product type and every geographic, and finding the exact destination is something we can definitely help you with. If you have any questions about the 1031 exchange process, selecting properties, the different characteristics, I would be glad to send you the little cheat sheet chart from earlier, but I'd be more than glad to go over that with you over the phone or in a Zoom call, and we can kind of figure out what might be best for building a plan around your 1031 exchange. This is the Everything Apartments podcast. I'm your host, Eric Christopher. Stay tuned for another episode coming soon.